the question I want to leave you with is this. Why does it respect the levels I'm teaching here in the logic from imbalance to liquidity if everything is based on trend lines, moving averages, harmonic patterns, Fibonacci this, Elliott wave that? If those things were real and they had factors that really made price go higher or lower, answer this for me. This is the riddle you need to figure out, okay? How does the market know which discipline it's going to follow any given day? Is it going to follow harmonic animal patterns? Or is it going to follow Elliott wave? Or is it going to use supply and demand? Or is it going to use volume profile? Is it going to use Wyckoff? Is it going to use the patterns that's found on range bars? Is it going to use what's in Ichimoku? You getting the point yet? All of those disciplines do not agree. All of them. They're at odds with one another. One discipline's going to say, wait for this. One discipline's going to say, wait for that. So how is it that the market determines which discipline it's going to use for that given time period or that day? That's nonsense. That's you being religious. Any of you that subscribe to those ideas, and I did, you are under a faith-based premise that what you're learning should work, when it's not based on any of those things. The markets only book and print these candles based on two principles: liquidity, going above old highs for buy stops, going below old lows for sell stops, or rebalancing or creating imbalance. So it's imbalance, rebalance, run for liquidity. That's it. It does not do anything else. The algorithm is not looking at harmonic patterns. It's not thinking, well, I haven't used the bat pattern in a while, so let's drive on batty. It's not thinking, I want to scare the living hell out of them and create a shark pattern. It's silly. It is silly. And I know some of you trade like this, okay? And I'm not trying to make fun of you. I'm just asking you to be highly critical about a perception of what it is that we as traders do and how much a fallacy it is. When you strip all that stuff away, and it sounds like I'm biased because this is what I'm teaching you, but notice what I'm doing. I gave up millions of dollars a year to come out here and teach for free. I could still be making millions. There's many of you are still asking, can I just join on your page? No, you can't join. Be happy. I'm teaching mentorship right here. Come on. What's in it for me? Folks, what I'm teaching you is literally a ATM machine in your hands. I'm giving you the PIN numbers. Every time I do a video here, I'm giving you another digit. And once you figure out what is it you want to do with this content and make it part of you, and you'll see what I mean by that. Right now, you might see me showing you. It's like, man, this makes perfect sense. But don't lose sight that you're feeling that splash over because I'm literally taking you into the chart and showing you what I know. And you're excited because you know the opportunity is available to you if you stick to this, and that's the right perspective. But don't lose sight and think that, oh, I just watched that video and I'm going to go out there and trade, because I've had some people post in the comment section and they try to do something with live accounts, which I already said, no, don't do that. And they're saying, I don't think these concepts work because I tried to do this and I tried to buy this fair value gap today. And you know who you are, and I'm not trying to make fun of you, I'm not talking down to you, but the bias is bearish. So if the bias is bearish, would you go in looking for a bullish fair value gap? No. That's the purpose of having a model. And then with that model, each morning, before the markets even start trading, you write down what your intentions are. What does that mean? If you're trading against what that daily time frame or daily chart is likely to be doing, you are absolutely asking for failure. You're asking for it. You're begging for it. That's not to say that you can't go long when the daily chart's going lower. But why would you want to? Why would you want to swim against the tide? Why would you want to be the salmon? The salmon that fights its way up against the current just to get to the top of the river, spawns and then dies. You got there but failed in the end. You want to be working with the tide. You want to be moving with the ebb and flow of these markets on a higher time frame, because that daily chart, if you understand that daily chart, if you're doing all of your analysis and linking your trade ideas based on the logic behind this time frame here, you're going to avoid a lot of losing trades. Now, you're going to lose, and you're going to have losing trades. I have losing trades. But you're going to avoid the silly mistakes that the majority of retail traders make. You're not going to see why, on a 15-minute time frame or a 5-minute chart, why it's not turning around and reversing intraday when it feels like it might be doing so. Because you'll have these small little, quick, dynamic little pops in the direction it's counter what the daily chart's suggesting. Those are just little traps. They're little moves that get people caught up in, oh, it's going to reverse, and you get in and chase that. And then it just creates another selling opportunity when the daily chart is likely to continue going lower. So you have to submit yourself to what this daily chart is doing. What's it reaching for? And when it reaches it, stop. Get a lay of the land again. Check your bearings, which is what I'm going to close this video with now.